Well, hello everyone. It's Corey Hoker here with a quick update on the One Big Beautiful Bill Act that was just passed into law here in July of 2025. Get some questions from clients about the impact this is going to have on retirees and pre-retirees. So I'm just doing this very short, quick video to hit some of the highlights. Now, this was a big bill. There was a lot in here. We're going to talk about just those things that are very specifically going to impact retirees and pre-retirees. So just a few quick highlights for you on this bill. The first one is the income tax brackets are locked in. If you recall, taxes were scheduled to go up on January 1st, 2026 without action by Congress. They've now fixed that, and we now know with certainty where these tax brackets will be for the next several years. Part of this bill actually gives a larger standard deduction going back to January 1st of 2025. And there's a new valuable senior deduction. President Trump ran on the promise of not taxing Social Security. They couldn't quite get that far, so they included an additional deduction for seniors that we're going to talk about. Downside to that is it's currently only temporary, so we'll talk about that. Much larger state and local tax deduction available, again, on a temporary basis. And then a new piece of legislation we didn't see coming is there is now a charitable contribution deduction, even if you are taking the standard deduction and not itemizing, although that kicks in next year. So let's just go through these real quick. Let's talk with probably the biggest impact to retirees and pre-retirees, and that is the new senior deduction. What this is, it is an additional deduction amount for anyone age 65 or older. If you were 65 or older on December 31st, when you go to file your tax returns in the spring, this is a new deduction for that age group. It does not matter if you're working or retired. It doesn't matter if you're collecting Social Security benefits or not. It actually doesn't even matter if you're taking the standard deduction or itemizing it. You still get this senior deduction. And what it is it's $6,000 per individual, so $12,000 for a married couple filing jointly, that you don't have to pay taxes on. So on the screen here, I'm showing you what the current standard deduction would be for a single individual. And then if you're married filing jointly, depending on one or two of you are age 65. So you can see there on the left, the single individual this year, the standard deduction got a boost. Back at the start of the year, it was scheduled to be $15,000 for singles and $30,000 for married couples. Well, this bill boosted the standard deduction and then gave us the additional senior deduction. So you can see a single individual filing their tax return, the first $23,750, no taxes whatsoever. So taxes only start kicking in on the amount above that. You can see in the middle the numbers if there's married filing jointly with only one spouse age 65 or older on December 31st. Look at the far right, and let's look at the two spouses married filing jointly, both age 65. Look at that number, $46,700. This is a big number, okay? What that means is the first $46,700 of income for a married couple, no tax on the federal level. That's huge. In fact, if you are a married couple filing jointly, both age 65 or older, if you have $100,000 of income, you're still only in the 12% tax bracket, and it's only the amount over $46,700 that gets taxed. So this is a big benefit. Most seniors over age 65 will see a reduction in their taxes because of the One Big Beautiful Bill. So that's some good news there coming out of Washington. The other big change is to the SALT deduction. SALT stands for state and local taxes. So this is your state income tax, if you're in a state that assesses that, and also your property taxes. So you take all that together, and prior to 2025, it was limited to $10,000. That was it. Didn't matter how much you paid in taxes, you could only deduct $10,000. What this deduction increase does is it jumps it to $40,000 instead of 10. But as you can see on the chart here, it's only for 5 years. And then it drops back down to 10,000. The other important note is that this goes away. This deduction does go away for high income households at $500,000 and above. So we're focusing on pre-retirees and retirees, so probably not applicable there. Again, if you're claiming the standard deduction, you don't care about this. But I point this out because people in a high tax state who are still working, you're just about to retire, so maybe you are still paying those state income taxes. You're in a high tax state that assesses high property taxes. If your standard deduction is $31,500 for a married filing jointly, you only itemize if you go over that. Well, now, if you can include up to $40,000 in taxes paid, plus other deductions like charitable contributions, mortgage interest, very high medical bills, you might be able to deduct and itemize when you haven't in the past. So again, this is probably for those people who are pre-retirees, but we'll want to look at this. In the last several years, over 90% of taxpayers just took the standard deduction. We'll expect more people now to itemize because of this, but again, it's temporary only for 5 years. But again, good news, should lower taxes for a lot of individuals. The last thing I want to cover in this short video is the change to charitable deductions. Now, this does not apply to 2025. It applies to 2026 and beyond. But what it does is it allows people who are claiming that standard deduction, go back a few slides to that first one we showed. If you're claiming just the standard deduction and you were giving to charity in the past, you didn't get any tax deduction for that. Now, even if you are taking the standard deduction, you can claim up to $1,000 if you're a single individual, or $2,000 for married filing jointly for cash donations. That's very specific. Donations to like a Goodwill or other charitable organization of items, clothing, furniture, that does not count. Also, people who are giving appreciated stock, that does not count. It must be a cash donation. So starting in 2026, you will want to go back to keeping track of those. A lot of people have not been doing that because we didn't itemize for a lot of people these past few years. Going forward in 2026, you will want to keep track of your charitable deductions, even if you're claiming the standard deduction. So just a quick recap of the highlights. Again, taxes are not going up on January 1st, 2026. That was the law of the land for the past 8 years. Congress now has given us some stability. Most people will at least see a small tax cut with the increase of the standard deduction, but most seniors over age 65 should see a significant tax cut because we have that much larger new senior deduction. But the big thing is this gives us more predictability in tax planning. So as we start to plan out, should you consider Roth conversions? Should you consider qualified charitable distributions? Some of those things, we have some now stability under the quote unquote permanent tax cuts with this one big beautiful bill. I always specify a future Congress and a future president can certainly change all of these things, but at least we have a direction and people will start planning accordingly. So hopefully this clarifies a few things. There are a lot of other items in the one big beautiful bill. we are only talking here today about those things that will impact people we primarily work with, which are retirees and pre-retirees. So hopefully you found this video helpful. As always, if you have additional questions, feel free to contact us. You can go to our website, newgenwm.com, schedule a phone call or a visit where we can go over your specific situation and help you there if needed. So hopefully you found this helpful. Hopefully it was short enough you could watch the whole thing, and we'll keep you posted as future updates become available. Thanks for checking in.